Hi friends, my name is Chetan Podar and today I'm going to be talking to you about Bollinger Bands. Bollinger Bands are one of the most popular indicators around the world. Most of the people use Bollinger Bands, but I'm going to give you a very short and quick tutorial how to use Bollinger Bands effectively. Like I told you, my name is Chetan Podar and I'm a professional trader. I'm also a trainer of investments, trading and stock markets. I run a couple of pages on the internet. Do check them out. One of them is called as Investments, which is on Facebook. So you could just go down to Facebook and like it, and you will be able to follow it. I also have three web pages which are basically blogs. One of them is called as invest-mints.blogspot.in, funnyfishmarket.wordpress.com, and funnyfishmarket.blogspot.in. Okay, that's me with John Bollinger. John Bollinger was in Mumbai some time back. I was very lucky to spend some time with him and talk to him about trading. So he is the person who kind of makes magic happen. So this is how Bollinger bands look like. Bollinger bands are basically two bands. This is called as the upper band. This is called as a lower band. Yeah. This is the price of the stock. The representation of price of the stock is in candlesticks. So the prices are going up. The band follows the prices on the upward side. A lower band also follows the prices on the upper side. As the price starts moving down and turning down, the bands are also following it. So this is the representation. Bollinger Bands is a technical tool which was created by John Bollinger in 1980s. It is one of the most popular tools which are used around the world. The purpose is to provide relative definition of high and low. Prices are high at the upper band and low at the lower band. They are used for high probability trade entries and exits. You can use them for stocks, futures or Forex. It is used to follow the volatility of the price. So let's understand how do we calculate Bollinger Bands. Bollinger Bands are calculated by using two standard deviation from moving averages. The setup consists of a simple moving average with upper and lower band. When the volatility is high, the bands expand. When the volatility is low, the bands contract. When price touches the upper band, the stock is said to be overbought, and when the price touches the lower band, it is called as oversold. Based on approaching price action, the idea of trading Bollinger Bands is not to look at the upper or the lower band, but to simultaneously look at both the bands together. Now here's the trick. Look at both the bands for clues. It works on the theory that 95% of the time prices will stay within the standard deviation from the mean. The problem with this indicator is that the tool does not tell us in which direction the price will move. It is used for entries and exits for trading. So this is how Bollinger Bands are constructed. This is the upper band. Let's look at 5 different variations of Bollinger Bands. The first variation of Bollinger Band is called as the constriction. So this is called as the constriction. While we are looking at the constriction, this basically means that the volatility in the price is very low, and because the volatility in the price is very low, these bands actually constrict. So whenever we look at a band which is constriction, whenever we look at the bands which are constricted, you know that the volatility in the price is low and an imminent breakout is possible. Unfortunately, by Bollinger Bands, we can't make out whether the breakout is going to be on the upper side or the breakdown is going to be on the lower side. One variation of it is called as bullish expansion. Now the art of trading the bullish expansion is this, that while the price is moving up in a narrow range, this is fairly a narrow range formation, and as the price goes up, the trick is not to look at the band, the trick is to look at the bottom side of the band, and whenever the band starts turning around is where you will know that the volatility is over. So you need to exit here. This is called as bearish expansion. Again, the same scenario. There's a narrow range formation, and as the narrow range formation happens and there is a breakdown, while the price is piercing the lower band, start looking at the upper end of the band, and as the upper end of the band starts moving horizontal, this is where the volatility is over and this is where you need to get out of. Third variation is bullish up move. Whenever you have a trending stock, the price actually starts moving up slowly, and as the price starts moving up slowly, it starts and it keeps on touching the upper price of the band. What you need to observe is that the lower price of the band is also following the price. So here actually the volatility is fairly low and the price is touching the upper price of the band. Expansion variance. As the price is moving up, you notice that the band is also moving up, but somewhere along the line the lower band, instead of moving up like this, starts moving down, which means there is a disconnect between the upper band which is going up and the lower band which is going down. This is where the volatility has come into the price. So this point is actually going to define your exit here. So how do you use the Bollinger Bands and price objective targets? First of all, you can use moving averages as the price objective. We all know that moving averages are always dynamic demand and support and resistance zones. Once the moving averages are crossed over, Bollinger Bands become the next price objective. The bands, please always remember that the bands are always following the price. The price is not following the bands, but the bands are following the price. Once the price pierces the bands, it has a propensity to turn around and reverse, which means if this is a band and if the price is piercing the band, there are very high chances that the price will reverse. So let's look at it in action. This is the moving averages. This is the upper band, this is the lower band, this is the price. Moving averages work like support and resistance zones, which are dynamic support and resistance zones. Every time the price is moving from the lower side of the band to upper side of the band, this acts like a resistance. This acts like a support. Support is broken, price comes down. Resistance is broken, price goes up. So every time you take a trade here, this is going to be a price objective. You could also take a buy here, and this could also be your price objective. So if you want to do very short term trading, you could take a buy order here, this is your price objective, or you can take your sell order here and this would be your objective. Thank you so much. Thanks for listening. If you have any questions or comments or anything that you would like to ask, please log on to facebook.invest-mints, that is Facebook invest-mints, and I'll be gladly be able to help you with whatever queries you have. Thanks for listening and thanks for your time. Bye.